this matter.
Australia's major banks are among the most profitable in the world, but they're facing significant hurdles. A slowing economy has seen record low interest rates, squeezing margins, and regulators are also breathing down their necks, forcing up scrutiny and costs. And someone has to pay. Shareholders will be protected as much as possible. The easiest targets are savers. Here's finance correspondent Philip Lasker.
Retirees Gil and Elizabeth are watching their pennies. Their interest income is disappearing before their eyes.
We looked at it the other day and it's barely enough to buy a pizza, and definitely not a gourmet pizza.
With every cut, the impact on bank profitability accelerates and savers are the biggest losers.
Those who have prudently put money away are effectively going to be subsidising those who have borrowed. And the more that someone's borrowed, the greater the victory.
Georgia and Joel are winners, but they're cautious.
I don't feel optimistic at this stage. It wasn't that long ago that we were told that interest rates at 3% were emergency levels, and now we're down at 1%.
The home they bought 2 years ago may be worth less, and a hefty mortgage makes them feel vulnerable. They won't be spending the tax and interest rate cuts in the stores.
Our plan with the mortgage is to get rid of it as soon as possible.
Not only are households saddled with debt, but the market is saturated with mortgages. It's another hurdle for the banks.
The capacity for credit growth to grow from these levels, with the banks holding $1.5 trillion of mortgages on their books, is difficult. And some of these other areas where they're earning decent returns, such as the fees, won't be there in future.
That's thanks to increased competition and the Royal Commission highlighting the scandalous charging of fees. Lending standards have been eased, but they remain tougher than they were at the height of the property boom. ASIC has asked banks to explain why they shouldn't be required to verify every part of a borrower's financial circumstances. All this adds costs to the business of banking.
It is an adjustment to what has been a very profitable industry over the last 30 years.
A big part of the adjustment is the transition to a period of ultra-low interest rates. Every cut is costing the banks 3 to 4% in profits because the money they pay savers through deposit rates can't go much lower, but borrowers are receiving bigger discounts on their home loans.
In a loan growth environment where they're hoping that loans will pick up, deposit growth needs to be at a similar level, but we now have a low interest rate environment which puts pressure on deposit growth.
Banks are sitting on more than $2.8 trillion in deposits, but growth has slowed since 2015. They're also paying less than the Reserve Bank's cash rate of 1% for 30% of that savings pool. Investors who need savings to generate income, like self-managed super funds, have been holding less cash as a proportion of their growing funds, taking on more risk and keeping only enough cash to pay their pensions.
If you're looking at the other available options to generate income as a saver, you're not spoilt for choice.
As Australia's interest rate structure falls, investors are buying bank shares, ignoring the increasing hurdles faced by the sector over the longer term, like weaker loans growth and higher costs.
If earnings in 2 years are threatened, if we have higher regulatory costs, and if bad debts return to more normal levels or unemployment increases, you could see bank dividends cut.
There is always the pension, but Gil and Elizabeth see themselves as victims of an intergenerational battle.
And the ones that are out there buying homes at the moment, so few of them have learnt how to save. And we saved, and now we're being penalised.
They are, in fact, collateral damage in a battle to speed up a flagging economy.
Philip Lasker there, and bank woes continue with Deutsche Bank's Australian business caught up in a sweeping restructure. The German giant announcing 18,000 jobs will be slashed globally by 2022. The company's equity business is in the firing line, with staff briefed on the weekend about a retreat from financial services. The global job cuts announced by the Frankfurt-based bank will reduce the workforce to 74,000. Deutsche Bank has struggled with regulatory fines, weak profits and a falling share price. To the markets now, and the ASX posted its worst fall in 5 weeks. The ASX 200 and All Ords lost more than 1%, dragged down in particular by the banks and healthcare stocks. The Australian dollar is now buying just under 70 US cents.